In a recent development, Gary Gensler has made it clear that hedge fund audits are on the horizon. This revelation has raised important questions from Senator Elizabeth Warren regarding the state of market regulation. Warren is asking why a significant portion of the market, accounting for three-quarters of its activity, remains inadequately regulated under the current oversight of the SEC, Securities and Exchange Commission, and FINRA, Financial Industry Regulatory Authority. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But before that, alert: this is not a financial advice video. Gary Gensler, who chairs the SEC, responded to Warren's inquiry by shedding light on the proposed regulatory changes that are in the works. These forthcoming measures include quarterly reports and annual audits for hedge funds. The goal behind these initiatives is to provide investors with a more comprehensive understanding of their investments, including their interests, risks, and exposures. These reports will offer both current and prospective clients valuable insights into the hedge funds that they are involved with or considering. Elizabeth Warren's concerns stem from the fact that a substantial portion of investments currently lacks the fundamental protections that investors deserve. In her view, the SEC, which is responsible for ensuring the honesty and integrity of financial markets, has allowed private equity firms and the companies they control to accumulate investor funds without the necessary public verification of the accuracy of their financial records or the disclosure of potential risks. Senator Warren insists that it is within the SEC's purview to address this issue promptly. Gary Gensler acknowledged Warren's concerns and acknowledged that the SEC has already taken steps towards enhancing transparency and accountability. He pointed to recent regulatory changes, such as the requirement for quarterly reporting on fees, performance metrics, and side agreements. Additionally, he emphasized that these new regulations also mandate annual audits of these financial documents. However, Senator Warren was not entirely satisfied with these measures, expressing reservations about two critical issues. Firstly, she noted that there is still no requirement for audited financial statements for these investors, which could leave a significant gap in transparency. Secondly, she highlighted the lengthy implementation process for these SEC proposals, suggesting that a more urgent response is necessary. The heart of the matter lies in the stark contrast between regulatory frameworks and the varying implications they have for different entities. Small family offices, large hedge funds, private equity firms, and the wealth management industry all operate under different regulatory rules. This creates a complex landscape of financial oversight, which can be challenging to navigate, particularly for investors. One of the key issues resulting from the delay in implementing SEC proposals is the uncertainty faced by potential investors. If an individual or entity is considering joining a hedge fund mid-quarter, they may find themselves in a situation where they lack crucial information about the fund's exposure and current financial losses. A significant concern that has emerged from this scenario is the fact that audits will likely occur only on an annual basis. This extended time frame could potentially create opportunities for manipulation within the intervening months. Critics argue that this delay may allow hedge funds to improve their balance sheets, attracting new investors with the illusion of low risk. However, when the fund eventually begins to liquidate losing positions, it may lead to rapid and severe complications. Recent articles and reports have highlighted the veil of secrecy that surrounds many private equity firms and hedge funds. These entities often operate outside the regulations that govern publicly traded companies, and as a result, they are not subject to the same level of scrutiny. This lack of transparency extends to their fundraising methods and operational strategies, which they actively seek to shield from public view. One specific SEC proposition has raised eyebrows in this regard. It aims to prevent fund owners and managers from offering exclusive deals to select fund members or investors. Under this proposal, even if many individuals invest in the same hedge fund, only a chosen few may receive preferential treatment or superior execution. This particular proposal has sparked controversy and resistance, particularly from market makers. These entities are concerned about the potential impact of this regulation on their profitability, as even small changes in order execution can result in substantial financial losses. This resistance has led to debates and discussions about the best execution practices within public markets. In summary, the debate surrounding hedge fund audits and market regulation is a complex and multifaceted issue. While regulatory changes are in the works, there are still concerns about the effectiveness and timeliness of these measures. The level of transparency, accountability, and fairness in the financial markets remains a topic of significant importance, and it will continue to be a subject of debate and discussion among policymakers, regulators, investors, and market participants. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.